Although I've been reading full-time about Bitcoin for the past 8 years, diving into so many studies, scientific articles, and more, I was still surprised. We all know many different models that attempt to forecast the price of Bitcoin, like the power law model, which I recently made a video about, or the stock-to-flow model, macroeconomic models, and so on. But the model I'll show you today from this scientific paper not only includes the limited supply of Bitcoin, the maximum 21 million, but also demand. And what comes out of that with just small changes in demand is truly astonishing. So if you're in the mood for a really juicy copium video this weekend, you're in the right place. With that, let's get started. Bitcoin is different. A very warm welcome to a new video on this YouTube channel. Before we dive into the study, let's go over a few basics. Bitcoin is fundamentally different from any fiat currency like the Swiss franc, euro, or US dollar, and also from other asset classes. Bitcoin is limited to 21 million, and this cap cannot be changed. No more than 21 million Bitcoin can ever exist, which already makes Bitcoin very special and naturally changes the rules as we knew them. The second important thing, institutional interest and demand for Bitcoin have increased significantly in recent months and years. We see a constant withdrawal of available Bitcoin from the market, and that will also be very relevant, because even small adjustments here drastically impact price projections due to the limited supply. Now, let's look at the article. Of course, we won't make a 2-hour video dissecting every section, but I'll quickly explain the most important parts so you understand how this paper is structured. As mentioned earlier, the first section talks about all the existing models: stock-to-flow, energy-based valuation models, macroeconomic models, like those based on M2 money supply, which we've also discussed often, network models, in the direction of power law, and quantitative statistical methods. But most of these models ignore demand and limited supply, and this paper attempts to address that. Then the paper defines a few parameters. For example, how many Bitcoin are currently available? They estimate that to be about 11 million. Why? Because out of the maximum 21 million, nearly 20 million have already been mined. Not quite yet, but many are lost due to inaccessible private keys, and a large number have been hodled for years and likely won't be sold. So the amount of Bitcoin actually available and able to change hands is estimated at about 11 million. Then the model plays around with the parameters and how they impact price. In total, 3 main variables are used. The constant, 11 million available Bitcoin, the amount of Bitcoin removed from circulation daily, for example, ETF purchases, etc. Simulations were run with 1,000, 2,000, 3,000, and 4,000 BTC being removed per day. Demand, whether it stays constant, increases 10x, 30x, or even 40x over time, over a longer-term horizon like 5 to 10 years. Some might say a 20x, 30x, or 40x increase in demand is too much, but I'd be cautious about that. For example, Google Trends is currently at just 18% of 2021 levels. And we're talking long-term here, over the next decade, not a 10x spike tomorrow. So it's very much in the realm of possibility. Now we get to the first exciting chart, where all 3 variables are combined. Daily supply removals of 0, 1,000, and 2,000 BTC. Demand multipliers, 10x, 20x, 30x, 40x. Even with just a 10x increase in demand, we see that Bitcoin's price could exceed $1 million if we have daily withdrawals of 2,000 BTC. That's projected for around April 2036, so in about 10 to 11 years. But if demand increases 40x and we still have 2,000 BTC withdrawn daily, the price could reach $4.5 million. You can see how sensitive the price is to small shifts in demand or supply reduction. We massively underestimate the impact of rising demand, especially under Bitcoin's fixed supply paradigm. This is a paradigm shift. We're not used to assets that are truly scarce. For example, with gold, if demand increases, more mining becomes profitable, and the supply increases. With Bitcoin, that's not possible. Even if demand increases 100x or 1000x, supply stays fixed. We've never seen anything like this before in human history. This study illustrates what can happen when demand rises sharply for something truly limited. Now let's get to the most exciting part of the paper published in the Journal of Risk and Financial Management. By the way, this paper was revised again this year to reflect updated pricing. Everything still checks out. Two scenarios were modeled: a realistic, conservative scenario, a bullish scenario. Different parameter combinations are shown in chart curves. Blue line equals 4,000 BTC removed per day. Red equals 3,000, black equals 2,000, green dashed equals 1,000. What matters is not the exact price numbers, but the relative impact. Comparing green to black, red, and blue lines shows even small increases in supply withdrawal at constant demand have a huge impact on price. This only works because of Bitcoin's strict 21 million cap, many of which are lost or hodled and won't re-enter the market. So even slight demand increases or supply reductions can cause major price spikes. In the bullish scenario, it's even clearer. 1,000 BTC removed daily, linear price rise. 2,000 BTC, slightly exponential rise. 3,000, steeper curve. 4,000, explosive price growth. At 4,000 BTC removed daily, Bitcoin could hit $5 million by 2031 in just 5 years. Honestly, that's not so unrealistic. This depends on whether spot Bitcoin ETFs keep buying, institutions continue to follow treasury strategies a la Michael Saylor, Bitcoin keeps being withdrawn from liquid markets. Currently, this is happening. And don't forget, after every Bitcoin halving, fewer coins are mined, making the supply even tighter and these scenarios more plausible. It's harder to forecast retail and institutional demand, of course, but looking at the past 15 years of adoption, a 20x to 40x increase over the next decade isn't unrealistic. Final takeaway. It's very hard to pin down precise parameters, but no matter how you model it, the limited supply of Bitcoin means rising demand will have a far bigger impact on price than most people assume. That's what I wanted to leave you with this weekend.